All right, Bruce, let's get started, buddy. We've had I think I filled you in on this so everybody knows. I talked to Bruce last week. Deephaven was one of the first companies Zenith 2.0 got approved with, and we hit a little snag right off the bat. I found out my warehouse lines won't fund, none of them want to fund non-QM loans, but then Bruce was able to connect me with another funding portal that I can use. They've approved us to fund the non-warrantable product that we do through Deephaven. I like that because we have more control over that process and how it's going to go and how it's going to flow. So, and then I just told him that, we've been open because of Mike Stoddart's involvement. We've opened up our eyes to what the opportunities are in the non-QM world. And the more I talk to people about this, the more I realize we've really missed an opportunity here that we're going to definitely be able to capitalize on. So Bruce, I'll let you take it from there.
Absolutely. Let me share my screen. Did it work? It should be showing now. Do you see the Deephaven?
Yep.
Perfect.
Yep.
Well, this product, I've been doing this for 3 years when I came over to Deephaven Mortgage. When I started in the industry 38 years ago, I was in A paper and then went into the subprime world with RFC, IndyMac, and so forth. Then went back to the A paper world with New Res for 23 years. And then 3 years ago, came back to this side. I can say this is the funnest product and products I've ever offered, because at the end of the day, I feel like I've made a difference. I'm not just doing a normal, just a transaction. These are loans that borrowers need because of certain circumstances, either be it the way they show their income, not really credit challenges, because that's not what we deal with. These are high quality borrowers, but they're just fun. So we're going to talk about 3 A paper products, then we're going to talk about 3 second mortgage products. And then at the end of that, we're going to talk about our construction products, or RTL products. I have a hard stop. I have to get off about 9:57 to jump on another call after that. So we can always answer any of the questions later. But let's first go through Deephaven Mortgage. Who are we? We are the oldest non-QM lender. We've been around since 2012. We've been through it all. We're owned by a parent called Pretium Partners. Pretium Partners is a massive $600 billion private equity firm. So they have plenty of funds. That's why we do all the products that we do. They also own a company that owns, I think it's 110,000 residential rental units. That's called Progress. Then we have our anchor loans. We have our Celine Finance, which is our servicer. So everything's all interconnected. So when you're dealing with me, you're dealing with the whole firm. So if you have a servicing problem, you come with me with a servicing problem. So that's the whole benefit of working with the Deephaven ecosystem. Okay. Let's talk about non-QM. Where's it been? Where's it going? Non-QM in 2023 was about 37 billion. 2024, it went to 65 billion. 2025, it's going to go to 80 to 100 billion. So it just continues to grow on itself. It's been a space where these borrowers have always been there. Self-employed borrowers have always been there. They're in every city. They're in every town. They just never been able to get the loans because their banks can't do them because they're creative on their tax strategies. There's also short-term, long-term rentals where they can't qualify with a normal loan. That's why we have the DSCR.
That was a really great. I think that's the best politically correct way of saying what you just said about the borrowers being very creative with their tax strategies. I love that.
and we know it, and we get that, and we understand it, and that's why we go up and look at other alternative income sources. These are high-quality borrowers. You're going to see that here in a second when we show you that. So they make the income. They don't default. They make their payments, okay? The other emerging sectors, one is like I talked about, RTL. I don't know if you heard that term, residential transition loans. This became popular with fix and flips, where all the fix and flip shows on Discovery Channel and everything else. Well, everybody's getting into that now. So we have the fix and flip product, the ground up construction product, and the bridge loan through our sister company called Anchor, which you'll have access to those as well. And then second mortgages. Let's talk about second mortgages. I have a first mortgage I will never touch. I'm a 2 3/8% interest rate. I will never move. I will never sell. I will never refinance. But I do want to have access to my equity. So our second mortgages, we have 2 different closed-end seconds and a HELOC that we're going to talk about. big market for you to also tap. Okay, let's talk about the first product, Expanded Prime. This is our number one product that we do probably most of our loans on, about 60% everything we do. So these are borrowers that are just outside of agency. We don't have a jumbo loan or a conforming loan. We just go 100,000 to 3.5 million. It's just whatever that loan amount is. Okay. What are these loans? What do they look like? 660 minimum FICO score, loan amounts up to 3 million, up to 90% purchases and rate and terms, 80% cash out. We allow for 1 times 30 on a mortgage late in the past 12. However, 48 month seasoning on a BK, 50% is standard DTI. That's just, there's no front end. It's just a back end of 50. Rent-free borrowers allowed, which is interesting. We offer all the different products, but everybody just does a 30-year fixed. There's a 40-year IO. Once in a while, people will jump in on that, but usually it's 30-year fixed. Cash out up to $1 million. All the type of product types, including non-warrantable condos, which is a big deal. And we allow up to rural properties up to 15 acres. Investment properties under the same product only goes to 5 acres. So a little bit more lower risk on that. First-time home buyers are allowed on primary and second homes, but not a first-time home buyer doing an investment property. That doesn't quite make sense. So that's kind of your credit quality borrower that you're going to see on there. But here's where you're going to use this product. It's the income options. All this we do really deep dive trainings. They're 30-minute modules that we do. So I'm just covering just a high level for you today. But it's really the income options. These are for borrowers that are either self-employed or they have tons of assets. So we use asset utilization or 1099 or P&L products. So let's first dive into full doc though. Full doc with us is 1 year tax return or 1 year W-2. Why would somebody be coming to me for a full doc loan? A couple different reasons. One, maybe the property type. Maybe it's a non-warrantable condo that can't get through agency. Or they're doing a debt to income ratios outside of agency, so they can't do it, so they're coming to me. But the most utilized is the bank statement product. Okay, this is the self-employed borrower. We state, you'll see all these little caveats up above. It says the employment must be stable for 2 years. Self-employment must be for 2 years. However, self-employment can be less than 2 years if the borrower has a minimum 2 years experience in the same line of work or related profession. So we see this a lot of times with restaurants. They just opened up a restaurant, but they worked at a restaurant as a general manager or a manager for 2 years prior to that. We can do that with that 1 year self-employment history. You'll just obtain 1 year's bank statements, be it either personal or business bank statements. And there's different reasons why you go personal or business. We won't get onto that today. That's a deep dive. But that's where most of the loans go, is through the bank statement product. We have a tool on our website where you get this 12-month statements, you upload them into our tool. Our AI system yanks all the income out of the bank statements, puts them on a spreadsheet. We back out the 50% expense ratio and give you the monthly income. It's that easy, kind of. You don't have to use the expense ratio that we use, the default of 50%, but that's just what we default to. Some are more, some are less. We average it out. But you can always go get a CPA expense ratio letter. Tell us what the real expenses are. Maybe it's 5%, maybe it's 20%. Whatever it is, that might increase the income that we have allowed from the bank statements. The other one we allow is the 1099. This is the independent contractor. This is the traveling nurse, or that just has been, they're kind of self-employed, but they're really an independent contractor. We'll do that. Just get 1 year 1099 and the recent 2 months bank statements to back up that income and prove that there's no business related expenses. And we'll use 100% of the 1099 income. Then the next one is the P&L, profit and loss. We have for 2 different P&L products. One is the P&L product at 80% loan to value, where it's always CPA generated, not audited, unaudited, but then they back it up with 2 months bank statements. Or if you drop the LTV to 75%, all I need is the P&L. I don't need to back it up with the bank statements. Kind of a cool product, just a CPA generated P&L. And sometimes with a self-employed borrower, they need to go P&L because, like a real estate agent, for instance, they get paid 3 months, they don't get paid for a few months, then they don't get paid again, then they do. So very inconsistent on the bank statement analysis, but a P&L just takes the yearly average. So real estate agents work really good on the P&L product. So those are really the main income options, but the next one is asset utilization. And you can mix and match any of the income types, either the same borrower or co-borrowers and borrower. You can mix and match all these incomes on the same application. It's just fine. Asset utilization is just that. In the conforming world, they call it asset depletion because they have to deplete their assets. We don't make them deplete it. We say a borrower has a minimum of $500,000. We take that $500,000 divided by 84 months. There's my income. It's kind of a cool stream. Or the other option, we have option 2 under asset utilization. Let's say a borrower has several $1,000,000. As long as they have several $1,000,000 and they have enough to cover the loan amount, the down payment, the closing costs, reserves, and 5 years of any other monthly obligations, there's no debt to income ratio created. There's no job listed on the 1003 and no employment listed on the 1003. It's solely based off those assets. Cool products where you can mix and match those. Any questions on any of those income options I just went over?
Yeah, I got one, Bruce.
Sure.
So if a borrower is self-employed for 2+ years, we just need 1 year tax return or the bank statements?
Yeah, if I
Whatever
wouldn't go
route we
bank,
want.
I wouldn't go tax. I would just go the bank statement route. Same
Are the rates
pricing,
the same?
identical,
Oh,
no different.
okay.
Just go bank statement. Because tax,
And those are all 90% down or 10% down up to 3.5?
it's called 89.99. So yes,
Oh.
technically 90%, but we go 89.99. Don't ask me why.
Well, that's good to know in case we're not getting pricing because of that.
Yeah, do 89.99. Yes, goes to that with a higher score, 740 plus score to go to 90%. 85% improves a little bit, goes down a little bit. 80% your sweet spot, and all these allow for gift funds. So if a full 20% is gifted, borrower doesn't have to have anything, no closing costs, no reserves or anything. Everything can be gifted.
Any MI?
So you could,
Sorry.
no MI. No, the risk is all built in with loan level price adjustments. So there's no MI on. Good question. Anything else on that one? Okay, non-prime. This is the borrower that's just outside of prime. I call this the credit hiccup borrower, or they had a speed bump in their credit maybe. You can see my minimum credit score goes to 620 versus the 660 that we had before. Cash out's not $1 million. Now it's only 500,000. Loan amounts only go up to $1.5 million. Limited trade lines are allowed. Okay. This means on my normal trade line requirements under expanded prime, they either have to have 3 trade lines reporting in 12 months, 2 for 24, or 1 for 36. In this one, as long as they have a credit score, that's all I need. I don't need to see those trade lines on there. It's just a score. And you see borrowers that have that every now and again, which is very unique. They don't meet the trade lines, but they meet our score requirements. And you can do that here under non-prime. LTVs only go to 80. They're capped to 80, nothing higher. We allow for a higher tolerance of recent mortgage lates. We allow for up to 120-day late in the past 12 months. So that's somebody that's getting pretty close to foreclosure, deed in lieu. Not that you want that, but that allows for that. We have lighter seasoning on housing requirements. Bankruptcy could be yesterday and take your application today, but you have to meet a minimum credit score of 640. Kind of hard to do that when you have bankruptcy yesterday, but it allows for that. Debt to income ratio is up to 50. This is the product that allows for ITINs, where somebody's an ITIN borrower. Lot deeper transaction we need to talk about. If you have one of those, call me on it. We'll go through it. They're very technical when you have those. This allows for all the same property types, non-warrantable condos. We actually do condo tells, but not condo tells where it's a hotel motel or marketed as a hotel motel. Like I live up here near Park City, Utah, and a lot of my condos, just 100% of them are investor concentration short-term rentals. That is fine and acceptable. It just can't be hotel amenities, maid service, other amenities like a hotel. It just can't be that. That's what we don't want to touch. But they can be 100% investor concentration on those investor properties, non-warrantables. This product still allows for investment properties up to 5 acres. It also allows for the 12 months bank statements, the P&L product, and the 1099. Just doesn't allow for the asset utilization. And first-time home buyers are allowed. So there's going to be times it may fit this one and doesn't meet expanded prime. So it goes either way. Any questions on non-prime?
I got one.
Yep.
On your non-warrantables, is there anything you guys won't touch? Like,
Yeah. Yeah,
the
lots of them we
insurance
won't touch.
issue is huge. Is there something like do you require the same stuff as Fannie and Freddie on that?
Not at all. I don't even look at their budget. I don't care about their budget. I'm not looking at reserves. I don't even ask for that. We have it's kind of a 2-page questionnaire that's very limited. Our main thing is we want to make sure, if there's any legal stuff going on, that it's maybe a slip and fall, that it's not a structural in nature, if there's any legal things. So yeah, there's a lot we look at, but a lot we won't look at either. So just run it past me. And we'll see if we can get it
your
done.
own
The insurance-
questionnaire.
The insurance, well, you said something, I think Chris asked about the insurance. Where are you guys on that? Like what's your deductible requirement?
Yeah, we have our minimum deductible and our maximum. Oh gosh, we have to look up the guidelines. It is pretty close to agency when you get into deductibles. However, under our non-warranted, we expand that out a little bit. I don't want to pull my screen up and look at the.
Yeah, you can let us know. No, you don't need. Yeah, you can let us know because that's one of the bigger hiccups that we've been hitting is the insurance deductible. And then from a percentage of business standpoint, how much of the business that you're doing? You said 65% of the business is that prime. How much of this is non-prime? How much of your business is this non-prime product? Because it seems like this is going to be a lot more limited.
Non-prime is about 5%. It's very, very, very limited. And the rest of it's going to be DSCR and second mortgages is where it's at.
Okay.
Yep.
And the non-mortgable condos would require 20%, right? Just to.
Yes.
Okay. Cool.
Yep. 20%.
So the non-prime non-warrantables, but the prime warrantables are 10% still, right?
Nope. They're 80% as well.
Oh, I thought I saw 90.
We allow for it, but not on non-warrantable.
Okay.
There's a caveat to that when you're non-warrantable.
Okay.
Good question though.
Got it.
Okay. This is the fun product, debt service coverage ratio. I love getting in front of real estate agents, and I'll do that. I'll offer you anytime you'd like me to get in front of a group or do a Zoom call with your real estate agents and talk about these products. I have a different presentation that's even higher level. But man, to see their eyes go off going, wow, you guys can do that? And it blows me away that real estate agents are not aware of these products. I'm like, who is not selling these? Who's not pushing this stuff? Especially to a real estate agent. A real estate agent, they buy investment properties every day. They're self-employed. They need these loans themselves. So it's good to push it with them. Okay, debt service coverage ratio. What is it? This is an investment property purchase, cash out, or rate and term where we're solely using the cash flow of the property to qualify the subject property. There's no employment and no income. That's it. Does the borrower cash flow? Does this cash flow? So look at the scenario down here below. The rental income, gross rental income of $1,000, PITIA is $1,000. That equals 1. That's called a 1 DSCR ratio. The next one below, our rental income is negative. We're only $750, and proposed PITA is 1,000. That's a 0.75, and that's the lowest we go on a DSCR factor is 0.75, and that's on a purchase rate and term. We won't go below that on a cash out. So it's really that easy. There's no vacancy factor applied. It's solely looking at the cash flow of the property. How do we know how we cash flow this? If it's a purchase transaction, there's no lease on it. Well, there may be, but we can't get the lease on the previous one because we don't have history with our borrower. So you're going to use the 1007, the comparable rent schedule on a purchase transaction. If it's a rate and term refi or cash out, and the lease agreement is higher and shows a higher monthly payment, you can use that, backing it up with the most recent 3 months rent receipts. So we can use the higher to create the DSCR ratio based off of that. The other cool thing we do, a lot of these borrowers, they want to just cash flow, so they use our interest only feature. So for interest only, you can calculate the DSCR off that IO payment. So instead of PITIA, it would be ITIA is what you'd be using to calculate DSCR. Now let's throw a little wrench in this thing. What about short-term rentals, which we do a ton of short-term Airbnb VRBOs? How do you calculate that rental income? That'd be here. So let's say it's a rate and term refi. Then I could get an Airbnb VRBO management report. You can get that printed out. The borrower provides you that. We would take the 12-month average and times it by 80% and give them 80% of the income. Why am I backing out 20%? Because there are management fees and vendor fees and cleaning fees associated with that. So for short-term rental income, it's gross rents times 80% is what we will give them for monthly income. If it's a purchase transaction, I don't have the Airbnb VRBO printout yet. So the appraiser is going to do what's called either the rent comparable schedule, which most of them won't do. They don't know how to do a short-term rental comparable schedule. So they do what's called a short-term narrative. And we can give you a sample of what that narrative would need to read. In that narrative, they're pulling data from a software called AirDNA. And you can even pull AirDNA to see what rents are going for in a specific area for short-term rents. But they can't solely use that. They have to back it up with either some data from what other rents are going for in that short-term rental, where they get information from Airbnb VRBO, and they just create a narrative based on that. And then we'll use 80% of that income. So that's the two scenarios when you do a short-term. But we're probably 50-50 short-term, long-term rentals with the DSCR product. It's become short-terms are a big deal these days, of course. And probably in all of your marketplaces, they're everywhere. They're in every town, every little city, short-term rentals, long-term rentals. So what are the attributes of a DSCR loan? Minimum 660 FICO, loan amounts up to $2.5 million, 100,000 minimum, 80% max loan to value. You can go up to cash out to 75, no mortgage rates in the past 12, bankruptcy, 3 years. Foreign national borrowers are allowed under this product. So it's literally somebody in Germany wants to buy an investment property here in the US. That's fine. We just cash flow it off the cash flow of the property. We get credit references from their country of origin. They prove that the down payment has been transferred here to the US, but their reserves can stay in their country. So we see a lot of that, especially in Florida. A lot of foreign national borrowers buying properties in Florida right now. Reserves, 3 months, 6 months, depending on what the loan amount is. First-time investors allowed, not first-time home buyers. Again, you can't have a first-time home buyer buying an investment property for the first time. They need to own a primary residence or have owned a primary residence the past 12 months. That deems them not a first-time investor. First-time home buyer. First-time investor is their very first time buying an investment property. We cap it out at 75% loan to value. Unique thing, gift funds are allowed again. This is an investment property. As long as borrower has 10% of their own funds, everything else can be gifted, down payment, closing costs, and reserves. Unlike conventional products, unlimited finance properties, where with agencies, you're capped at 10. The other thing, we allow you to vest in an LLC. We could also close in an LLC, but you're not approved for that part of it yet. So literally, think about this. The borrower doesn't even have to sign the note in that case. The borrowing entity, the LLC, signs the note and the deed. That's the other option down the road. If you ever want to get to that point, we'd have to set up your LOS system to accept LLC entity and make sure you're using the right doc prep company. But right now, you can vest in an LLC. So your borrower signs the note, LLC signs the deed. That's fine. You can do that now. And that's what most borrowers do. We also don't report any personal credit for any investment property. And that's really why these borrowers are trying to invest in an LLC or close an LLC, because they don't want this report on their personal credit. Well, we don't. These are business purpose loans, so therefore we don't report on personal credit. Even though we're pulling their personal credit, we don't report to personal credit. Okay? Same, non-warrantable condos, townhomes, PUDs, rural properties, but we only cap it at 5 acres when we're doing rural. We also have a 5 to 9 unit DSCR product. So we have 2 different ones. We have our DSCR 1 to 4 unit and DSCR 5 to 9 unit. 2 different matrices, 2 different price sheets that we offer under DSCR. Any questions on DSCR?
Yeah, Bruce, I've heard in the past other LOs, like when I've tried to ship one out to like Missouri for a DSCR loan, they're like, you can do it in any state because it's business purpose. Is that true?
I hadn't talked to Dave about this, but yes, there are 36 states in the United States that do not require the licensing of the loan officer or the company. So in those states, you could do a DSCR loan. Yes.
Yeah, get me the list.
You want that list?
Yeah, that was the next question. What's the list?
Yeah.
I'll send you the list. Okay, look at it. You're going to see it on it. It's going to show natural person, and then it's going to show DSCR LLC entity. Just look at the natural person side and look at you as a loan officer, and then look at the company and see if each have to be licensed or one or the other. But 36 of them, you're good. Okay, so I'll send that over to you when we're all done. So yeah, so you can start marketing to those states now and do a DSCR loan.
Hey, Bruce, on the DSCR there, the unlimited properties, and they've got numerous other financed properties. What are we documenting in terms of income for those properties, or is it only for the subject?
I only need income from the subject. So the only thing you're showing me on the other finance properties is you're listing them on the 1003. That's it. And list them and their PITI, but I'm not creating a debt to income ratio at all. You're just listing them.
Okay.
So the only credit part that we need to verify is the borrower's primary residence credit. And then this one, if we're doing refinance, we have to verify the credit on this one, the subject property. Good question. Remember I talked about we can go under 1 on that DSCR. When we do that, a couple caveats to it. It goes to minimum $250,000 loan amount, purchase rate and term only, max 70% loan to value versus 80%, minimum score 700. Reason being, that's a risky loan. This is a negative rent situation. So we want to make sure the borrower's got some skin in the game on that deal when they go in negative rents. Okay. We have all of our product matrices on the website. I can shoot them over to you as well. Exceptions. Because we are the lender, we do a lot of exceptions. Probably 25-30% of our loans that we close have some type of weird exception. Never going to go above percent of 50% DTI, so don't ever ask for that. But there's other case by cases. If the borrower has strong reserves or something else, absolutely we'll give an exception to it. We'll usually hit you a quarter point price it to do an exception. Resources, you have myself and Doug Smith, who's my CDA who works alongside with me. Reach out to us with any scenarios, or you can go right to our scenario desk and they'll reply back to you and give you the actual guideline, whatever you're asking about. We have all of our white label
Bruce,
flyers.
can I ask you something on the exceptions?
Yep.
You said you'll never go over 50% DTI, so don't ask. What will you give exceptions for then? Like what are the, because that would be the biggest one.
Borrower reserves, credit scores not quite meeting an LTV requirement.
Okay.
There's so many of them, and some come out of the woodwork. I'm going, they will never grant an exception.
But never DTI.
Never.
Got it.
In 3 years, I just had one approved this week. It was a closed loan, and somehow we were able to give them 52%. I don't know how we did it, but we did. So, but don't do it. Don't usually ask.
Okay, so not never.
What was the movie? Oh my gosh, Dumb and Dumber. So there's a chance? Yeah, no.
So you're saying there's a chance?
Yeah, you're saying there's a chance. Yeah. No, but yes. White label flyers, I can send these over to you, and you can market these same products, put your name, your company, and logo on there. Bank statement analysis tool. This is that tool I was talking about, where you upload the 12-month statements to us. We spit back a worksheet that looks like this, that comes out with the actual monthly income right there, be it personal or business bank statements. Giuseppe and I went through one of these this week, and your first time you look at the worksheet, you go, oh my gosh, there's so much data on here. But once we break it down, it's actually pretty simple, and we show you what we're looking at. We have our scenario calculator tool on the website, and then all the other tools and resources there on the website. We do a ton of trainings. These are all those modules I was talking about where we can really deep dive, and we can set up these for a group, for all of you, one of you, any of these. We can really dive deep into any of our products, anything there. Okay. So now let me unshare my screen. I want to go, I only have a few more minutes. I want to jump into second mortgages real quick. You guys doing many second mortgages yet?
Yep.
We need
yes
to.
and no. Okay. We have 3 different products. We have first the closed-end second mortgages. We call Equity Advantage, and then we have Equity Advantage Elite. Let's go over the difference on what those two are. They are closed-end fixed rate seconds. They're not purchase money seconds. They're standalone. So after the fact, borrower has to have ownership on the property for 6 months. Then we can come in and put the second mortgage on the property. So Equity Advantage, what is it? Well, this is kind of like we have our expanded prime and then non-prime. This is kind of that idea. The Equity Advantage expands out a little bit more. 750 loan amount, 660 minimum score. Loan amounts between this, we go up to this LTV. So there's just higher LTVs we go for. You can do full doc or bank statements and the P&L product on these second mortgages. Same that we do in our first, you can do them here on the second. Cash out ownership, like we talked about, minimum 6 months. Have to meet those trade lines or those limited trade lines. We then cap at 75% loan to value. Non-warrantable condos allowed. Mortgage history, no lates past 12. BK 48 months. So those are all the highlights we just went over there. Now, here's the LTVs. 85% max with a 700 score, 680 with an 80, 660 with a 75% loan to value. Okay, so think about that. That's the normal equity advantage. Now let's talk equity advantage elite. This is the higher qualified borrower. Max loan amounts a little lower, minimum score a little higher, 680. Cash out 6 months, same thing. We do not have limited trade lines on this. It's standard trade lines only. No non-warrantable condos, warrantable only. Does allow for interest only. But the pricing is that much better. Not that I show you here, but it's just that much better. 740 on your scores to 85%, 720. Okay, so you can just see it's a higher credit score borrower, but you really improve the pricing dramatically when you go equity advantage elite. It could be a half point in rate, or it could be 1.5 points better, depending on what coupon, what LTV, and so forth you're doing. So a lot available there. Okay. The other product we offer is Equity Advantage HELOC. This is done through our wholesale channel. So you would still work with me on it, but we would run it wholesale. It wouldn't be done on your warehouse line. We would submit it through our HELOC side. It's all automated. It's via our website. Still goes, again, not piggyback. It's got to be standalone on its own. Can't be used in a purchase transaction, but it's a HELOC. It goes up and down. It's fully adjustable. It does have some bank statement features in there, asset verification. So it has some cool features in it. It's just adjustable is the difference on it. And you run it through my wholesale channel. Okay. Last one that we're going to touch on. I love these products. This is probably my favorite product. This is through my sister company called Anchor Loans. Have you heard of Anchor Loans?
No.
Let me go pull that matrix up real quick. Give me a second. Anchor Loans does all of our RTL products, residential transition loans. So you've got people, investors. There it is. Now you can see it. Okay. You have a bridge loan, and these are all investor loans. So this is not like my construction product here is not for you and me going out to build our own home. It's not for that. It's for the small home builder, not your large time home builder, but a builder that just needs construction money. Maybe he does 5 homes a year and the bank doesn't always like to lend on them multiple at one point in time. Well, we'll do up to $20 million in one loan, and we can have 5 transactions going at one time for one borrower. So it's quite hefty that what we can do. Fix and flip. This is the borrower that is buying that home that needs to be rehabbed and then wants to turn around and flip it again. These are all short-term loans, 12 months, and 18 months. Okay. 1 to 4 residential units. There's an interest rate. Here's our loan to values based on these. There's no prepay penalties if they pay off early because these are construction short-term interim loans. Origination fee. This is our fee. It's somewhere in that range. Then you charge your fee on top of that. And these type of borrowers have no problem paying this because they can't get their loans elsewhere. Our minimum experience is 3 years, 3 completed transactions that they've done, as their industry. But the most of them we do are these fix and flips and ground up construction. So all the A and D has to be completed. So we'll do the vertical, but all the horizontal has to be completed. We could be a subdivision. We could be maybe the builder was halfway through the construction loan and the bank pulled out. Well, we'll jump in and finish it and take it over. We can do that. We could be, a lot of builders are building these to be rental properties after the fact. So they're doing build to rent is what we call them, BTRs. So they can use the construction loan for this, and then you're going to use my DSCR loan to take the loan out. So you get 2 loans. So the benefit with this is these type of borrowers doing multiple loans in a year. All your other loans, you get 1 every 4 years from a borrower. These type of borrowers, you might get 3, 4, 5, 7 different loans in a year from this one investor, from this one borrower. Be it a fix and flip, then changing it to a DSCR, et cetera, et cetera. That's why I love this product. It's a wholesale product that you broker to us through Anchor Loans. So you're not even have to put it on your funding sources at all. It's fully just a broker transaction. I went through a lot of stuff. Any questions on any of that?
But my biggest thing is, Bruce, these guys need to know that you can reach out to Bruce. I mean, I think that's where the biggest opportunity for Lyft is. We don't have a lot of expertise in this area, but he does. And so the fact that we used to not be able to do this, right? Like it seems like when we were at VIP, they would remove all the reps' names and phone numbers from the website, so we couldn't talk to anybody. And I think that's what there's a big opportunity here. We don't have that much time left because you got to go. I have a Zoom at 10 myself, but any other questions or any other feedback that anybody has that they want to, or maybe arrange a time to meet with Bruce right after this, or not right after this, but send him an email. But does anybody have anything they want to ask?
No, I mean, two things on my end. Just if you're able to send those slide decks, if you're willing to share those, I would love that. I think that'd be super helpful. And then I guess granted this is in the slide deck itself, but yeah, I'm going to try to dive into all those trainings you guys have, because as easy it is to sell the product, I want to make sure that the process isn't like the bumpiest thing in the world for the client. So I would love to make sure we're submitting clean stuff to you at the end of the day. And, probably might just hit you up when I lock my first deal and figure out how to submit it smoothly to you.
Oh, completely. No. When you even get an application and a borrower, just call me. Let's talk it through to make sure we do it right. Yeah. Then when you're ready to submit, I hook you up with Doug Smith, my assistant. He'll walk you through how to get it uploaded into our tool, into the TPO portal. Absolutely.
Yeah, Bruce was awesome this week. We had a question and he just hopped on Zoom and did a screen share with us. And then, I know we all learned about what changed wholesale the last couple of weeks. We were talking about, okay, it's brokered. We have to charge 2 points, 2.5 points. Ryan reached out to me right after and said, well, Deephaven is correspondent with us. I mean, they're underwriting it, but that means it's in Loan Pass. It means our margins are built in. And when I priced out the 2 loans that I had just pre-approved with change, the pricing was better, and it was better either with a point or even at par. So you don't have to sell anyone on paying 2.5 points. Now it was a jumbo loan. So I don't know, maybe if it was a $400,000 loan, you would have to pay some points because of the margins, but definitely I was super eye-opening because I had just spent 2 days selling these people on paying 2.5 points. And I'm like, oh, now I can get you a better rate without points.
That's confirmed, right, Dave?
Check it out.
We're gonna.
Like I said, I'm just, when you guys started to say that, I don't know. It's not confirmed. You and I just had this chat message. I believe it is. So we're gonna honor whatever price that you're quoting, but we wanted to just double check. I had Sherry running some tests where she was actually going in. Those of you that don't know, when you guys send in a lock, Sherry has to go to the investor website and upload all the data for the lock, right? It isn't automatically locked. So that's what that process is. And so anyway, she had entered some of the data, and I think you guys went back and forth, and I think we confirmed it, but I just want to double check. And if we have to make some adjustments, we will, but I think it's accurate. So I don't expect it not to be.
Yeah, I just was pricing while Bruce was chatting. It was I think the 5-6 arm was 6.99 or 7, and then the 30-year fix was 7.2, no points or at par. So pretty.
Yeah, that seems like it's a little aggressive.
Too.
So
I was gonna say, yeah, 90% down jumbo deals, dude. If we've got some good borrowers, and sorry, I know we got really quickly here, but W-2, when you say 1-year W-2, full doc, we'll just literally get in a W-2. That's it.
Mm-hmm. Yeah. Yeah.
I mean, what are we doing
here? Pay stub, during the month. Yeah. Depends on where we're at in the year.
Right.
You want a current pay stub, back that up.
Okay, cool. That makes sense. But still,
just 1-year tax returns, you never have to worry about declining income.
I mean, yeah, not even tax returns at the end of the day, too, right? You can do bank statements and probably increase your income way more.
Always.
One of the examples, one was a jumbo loan and they had a lot more money, but the other one, they own some trash can cleaning company. I don't know if you've seen those trucks driving around where I tried to pre-approve them last year. And then again, this year on their tax returns, their taxable income was Bruce, plug your ears, $15,000 a year or something. And the bank statement program came back at $25,000 a month in income to qualify.
Yeah, that's, and they make it, the money's there. So yeah,
Yeah.
we know it. Yep. Definitely.
This is the when you can solve problems like this, you become really popular to real estate agents. That's all it is. I mean, that was my experience. So when you can solve problems that other people can't solve, all of a sudden you're like the go-to. So
I
definitely want to invest your time.
This might be the most powerful product we've ever onboarded. Like this might change a lot. So I'm stoked.
To Ryan's point, though, you want to make sure that you invest your time to learn the product. Like, do those trainings. Don't shortcut this because you'll just shoot yourself in the foot. Bruce, thanks a lot for your time today. Really appreciate it. We'll have you on again. And everybody, you want to send me those slides? I'll send them out to everybody, and then along with your contact information. And thanks again, dude. I appreciate it.
Thank y'all. Look forward to working with y'all.
Thanks, Bruce.
Thanks, Bruce. See ya.
Peace.